one thing that we're always trying to find, and this I would call almost the holy grail of ESG, is, this idea of isolating or identifying a standalone ESG factor.
Welcome to the Future and Sound podcast. I'm your host, Jen Wilson. This is a podcast where we talk about prioritizing people, planet, and profit in business strategy and decision making. We'll have different names for this: ESG strategy, sustainability strategy, maybe integrated strategy. Whatever glossy terms you choose, if you're in the thick of this stuff, you know there's no silver bullet. Like in any strategy, you can't prioritize everything, so there are trade-offs and different views to consider. In this podcast, we learn from world-leading experts who share bits of wisdom that can help us see the future we want and our role in it. This isn't a normal business podcast. We're not interested in the latest trend, jargon, or branding technique. Instead, we go beyond the headlines and look to clarify our long-term view on resilient economies, competitive business strategies, and decision-making best practice. This is episode 7, ESG Investing in its Infancy. Quick story. In 2009, you remember winding through the English countryside on a bus with a few dozen classmates. We were graduate students at Oxford studying environmental change and management, and this was one of our many field trips where we'd learn about renewable energy, international environmental law, that kind of thing. This particular trip was memorable because two good friends in the program, Lila and Jisung, were deep in debate. When we arrived at our destination, I asked them what they'd been talking about. Essentially, they were talking about different vantage points that they use to see environmental problems and solutions. Jisung was trained as an economist, which allows you to zoom out and understand a wide-reaching problem like the impact of pricing carbon, whereas Lila, who trained as an anthropologist, had the tools to deeply understand how specific communities were impacted by environmental changes and how to effectively engage them in solutions. In summary, Jisung had the tools for a top-down understanding of environmental solutions, and Lila had tools to develop a bottom-up perspective. What we saw through our coursework that year is that a combined top-down and bottom-up lens can be very powerful. Today, there's lots of excitement about ESG investing. In fact, by some estimates, $1 in $3 of assets under management are labeled ESG. Questions still remain: how is ESG defined when it comes to investment? What does good look like? And what trends will shape the space in years to come? In my view, there's no one better suited to explain the noisy ESG investment space than our guest on the show today. Not only has he got deep experience in ESG investing, but he's uniquely placed to apply top-down and bottom-up approaches. Jason Mitchell is co-head of responsible investment at Man Group and co-chairs Man Group's Stewardship and Active Ownership Committee. He's worked with Man Group as a portfolio advisor since 2004, but took a 2-year break from 2008 to 2010 to advise the UK government on infrastructure development across sub-Saharan Africa. He returned to Man Group in 2010, but somehow managed to complete a master's degree in international political economy at the London School of Economics, alongside his portfolio management work. If that isn't enough, importantly, he's the host of a podcast I'm a big fan of. It's called A Sustainable Future, and I'd highly recommend checking it out. Jason, I'm delighted to have you on the Future and Sound podcast. Welcome.
Thank you very much, Jen. I'm really excited to be here with a fellow podcaster.
I know it's a bit meta, isn't it? Podcaster, it is. Interviewing a podcaster. It's excellent. I'm looking forward to it. I wanted to start with your journey. So you've been working, Jason, in the investment industry for about 20 years, the majority of which has been with Man Group. But in 2010, you took a break for a couple years to study international political economy at the LSE. How did that academic break influence the way you approach portfolio management?
Yeah, it was a pretty marked departure in my life, having been in the investment industry since the late '90s. But it felt like at a certain point you could tell where the economy was heading with the global financial crisis, and I kind of wanted to get away from managing money, specifically managing long short money. And I had always had an interest in infrastructure, and there was an opportunity to work with a German private equity firm called the African Development Corporation. And at first, it was advising them on their telecom assets, and soon that sort of overlapped into other infrastructure, specifically water infrastructure. And at that point, I started meeting other people as I went and started traveling to Joburg, Johannesburg, and other parts of sub-Saharan Africa. And then I came into contact with the Commonwealth Business Council, which is a part of the UK government in terms of promoting business among the Commonwealth states. And at that point, I started advising them on telecoms, water infrastructure, agriculture. And I kind of look back at that point as sort of the start for my own journey and just intellectual curiosity around what sustainability meant. And when I often returned to London, I looked into getting a master's at the LSE, which I ended up doing. But the plan was to try and sort of work at the IFC, in the Joburg office. I think what happened was, uh, I sort of met up with Man Group, or specifically GLG, the people that I used to work for. I always had a great relationship with them, and there was an opportunity to kind of follow that interest in sustainability in 2010 in the public equity sphere. So I rejoined managing the Virgin Climate Change strategy, as well as another global sustainability but thematic strategy. And so, I was able to sort of merge those two interests. I found, particularly at that point in my life, was incredibly fulfilling. I got to read and nerd out effectively with a lot of theory, which I think has come back repeatedly to kind of not just inform, but sort of direct my thinking around sustainability.
I'm interested as you apply some of those political theories. I love this topic of interdisciplinarity. I'm wondering, does that help with innovation in your job?
Absolutely. I mean, I'll give you one example, and it's continued to pay dividends. But I wrote my thesis on theory of domestic audience costs, this political theory that says, in a general way, that politicians, as a general rule, tend not to lie. And clearly, the last 5 to 10 years have shown some anomalies, i.e., Trump and a few others. But the theory holds that if you are democratically elected and you don't fulfill your commitments to your electorate, you get penalized in the next electoral cycle. And there is a long, long kind of history of evidence to support that. And I think it's been interesting to take that, for instance, and try to apply it in a ESG perspective. And so I'd sort of taken that and looked at what companies commit to, right? I mean, so we knew they certainly commit to certain things, and that tends to be financial guidance, forward-looking guidance, whether it's cash flow estimates or revenue guidance, and the market penalizes companies if they don't meet those or exceed those. But then the question is, what other commitments are they making, and what kind of value do they hold in the ESG space? And one of the things that I'd found incredibly rewarding about 5 years ago during the Japanese corporate governance reform, and this had originally started when Abe was elected prime minister in Japan in 2012. But you found that a specific kind of company would make a specific kind of commitment, and it tended to be this long-term returns-oriented commitment, returns, an ROE sort of guidance, and there was a very small cohort within the Japanese market that did this. And if you sort of started to unpack it, you found that there was this kind of linkage between better corporate governance and capital allocation, and the kind of long-termism that you want to see, that you'd expect to see from better managed, better governed companies. Effectively, these companies tended to manage themselves better throughout a business cycle. And you found this in the cross section of sort of stock returns for the companies that did this. And so, I mean, I won't go on and on about it, but I just think that now you've found this idea of commitment now manifest again in in net zero commitments, in carbon neutrality commitments, but now net zero. And the question being that what's the distinction between an ambitious commitment and an unambitious commitment, and how do we sort of assess or say those commitments from a market's perspective, with the idea that, as carbon becomes increasingly priced, that climate related commitment will gain more and more value over time?
Jason, you're co-head of responsible investment. And I think a few of the audience members might be wondering what falls within the responsible investment umbrella. How would you describe the different components of responsible investment?
Yeah, it's a good question to start out. It feels like the space is really evolving, particularly around the terminology and uses of it. Whereas 10 years ago, I had this sort of mindset of sustainability. And in fact, I think that still is deserved. In fact, actually growing in relevance when you look at how the EU is treating the space. I find that RI, or responsible investment, is still an incredibly useful, almost umbrella term that captures the dominant approaches or modalities within that, and that's per the GSIA, the Global Sustainable Investment Association. And so when I think of that umbrella or structure, I think of three dominant things, and by no means that's all of them, but the three dominant ones, and those are exclusions based, so screening. The second is ESG investment, and so that's about measurement. And then the third is about impact, so more about intentionality and additionality. And I think what I find useful about that is that within this umbrella, you find each of those approaches often overlapping in any given strategy. In fact, it's increasingly prevalent, but these aren't necessarily conflicting approaches. They can coexist. And I guess I would say what's been interesting to me over the last couple of years is now seeing, I think, ESG, which again I tend to think of as more about measurement and sort of tools for particularly around engagement. But I think that is becoming a catch-all term to describe the space. And so I acknowledge that. I mean, we see that clearly within the CFA's work. And I think that they're an incredibly legitimizing force in the space. But the fact that they just called their new certificate for ESG investing, obviously using that nomenclature.
And so when we're talking about bucket one, which is exclusions, that could be our strategy is to exclude tobacco or coal or that type of thing. And bucket two, I have a few questions about ESG strategies. But in the third category, you were talking about additionality related to impact investment. Can we just dig into what you mean by additionality in this context?
Sure, it's very different, I think, than how the mainstream ESG space looks at this. I think it's more it has its roots in the concessional part of impact investing. By that I mean that by additionality or by impact, you're trying to create a number of things, but there's an intentionality. So you are intending to create some sort of socio-environmental positive outcome that otherwise would not have existed, and that ties in with the additionality. So the additionality is you are funding or financing something that would have not otherwise been funded or financing, and so that's what makes it additional. You're kind of creating this positive outcome, and you're helping finance this thing that would not have been. And so generally that has been the domain of foundations that aren't looking for sort of outsized returns, maybe even no return, or DFIs, development finance institutions, like the CDC or the Development Bank of South Africa. And what you find is no one wants to lose money on these, but the emphasis or the priority is creating a socio or environmental impact alongside that financial return, or sometimes even in front of the return.
That makes sense. And if we dig into the second category, the ESG integration process, just at a high level, what are some examples of strategies in ESG that an investor could apply?
Yeah, so I'd say there two very different tacks. So I'll go over them really quickly. But one tact is the traditional fundamental bottom up process oriented tact, which is the world that I came from, where an investment team, a portfolio manager would go and manage a concentrated portfolio of companies. And in integrating ESG, what you're doing is you're shaping that investment universe around financial and non-financial / ESG considerations. You are using different types of data to kind of understand not just the risks, but the opportunities in every context. And typically, there is a iterative engagement model whereby the investment team is meeting either the board or the management team and going through obviously the earnings trajectory, the financial kind of questions, as well as key ESG issues. And you're always trying to sort of put together a much richer multi-dimensional mosaic of that risk and opportunity picture. So that's the traditional area. And I would say that along that side, there's clearly, when we think of stewardship, it's not just engagement. There's obviously a voting element as well. So typically, depending on the active element of that strategy, you're either proxy voting or you're even starting to participate in supporting shareholder resolutions and even potentially co-filing. So the antipodal kind of opposite perspective is not bottom up, but top down. And that's the quant perspective. And so a quant strategy, sort of by definition, is about breadth. It's not about depth. And so what you find is a portfolio that has potentially hundreds of securities or issuers, rather than a concentrated portfolio of 30 or 40 issuers. And that brings certain benefits in terms of diversification, and how you can sort of treat volatility and the risk characteristics. But clearly, there's certain things that you lose, particularly around that engagement. It's very difficult for a quant strategy to engage with companies and have that iterative process. So what you find is a sort of a much stronger reliance on creating a rules-based system around how to apply ESG or climate data. And so one of those, those strategies could look like, typically they'll have a carbon constraint, meaning it has a lower and an upper bound. So that portfolio must be, as an example, 30 or 50% lighter than the index. So that's sort of one constraint on it. Another constraint might be that portfolio has to sort of tilt or apply an ESG overlay, which means that you're sort of pushing or skewing the portfolio towards a better ESG score relative to the benchmark. You can do that in a number of ways. You can take out the worst performers, or you can overweight the better performers. But there are a number of ways you can do that, all trying to sort of solve for a specific kind of risk or tracking error profile.
That's a really helpful overview, Jason. Thank you. I wanted to ask a few questions related to common misconceptions in this space. So you've been focusing on the area of responsible and sustainable investment for over a decade. In the past year or two, we've seen ESG become much more mainstream in terms of a topic. And I'm wondering, as the industry gets up to speed, what are some of the common misconceptions that you often hear in the space?
It's a great question, and it's something that I actually reflect on a lot. I think, to go back to how I just sort of characterize the top down and bottom up, I think there's a misconception that there is a single approach towards ESG integration. And the reality is that quant top down approach and that bottom up approach are very, very different. In fact, there's sort of, I would even call it a kind of an ontological tension around that, or this sort of question of, it sort of drives the question of causality around ESG. Is it process driven? Is it this intangible process kind of created over time by great teams that can identify that? Is it driven by anecdote, i.e. case study, or can it be quantified without that kind of engagement in an orthogonal or uncorrelated way across markets, industries, and regions? And again, those are two very, very different approaches. I personally think that they have to coexist. There are parallels in other academic fields, international relations being one, where you have sort of this coexistence, I find, of rational choice theory, which is the quant approach to it in a way. What you're trying to do is make generalizable rules or theories about how the world behaves. And so that kind of balances against social constructivism, which is more anecdotal. So that's a theory that tries to explain away the anomalies, and I think those do work well. And in the same way, I think that quant and fundamental approaches can work well, but again, they are quite different. I think another misconception is grasping around the term alpha or outperformance. And so what you find, I think, by many data providers, managers, asset owners, are purported claims about ESG outperformance. And I think we have to, as an industry, kind of step back and at least be self-critical about what that means. I mean, first, there's a problem with the data. We don't have a lot of it. Everyone knows that in terms of comparability in history. So when you're dealing with data sets that are max 10 or 12 years, it's very hard intellectually to make a strong claim about performance or outperformance. That's where quantitative finance is sort of struggling with ESG in terms of how to make these claims versus observations. Secondly, in terms of alpha, I mean, the bigger issue, and this does actually come back to that quant point, is what is ESG? You know, if someone were to say ESG is outperforming, what do they mean by that? You know, how rigorous is that? And I think when you look at some of these purported claims about outperformance that are called ESG, if you kind of peel back actually what's really driving them, you find overwhelmingly it's other common risk factors. It's large companies versus small companies, so pharma French factors. It's quality companies versus value, quality with a capital Q. And that effectively means companies that are more mature, that have a more consistent, longer track record of returns, you know, ROEs or ROICs, and sustainable cash flow. And by populating a notion of ESG with these other common risk factors, it becomes a little bit problematic, right? I mean, is ESG just a sloppy amalgam of other risk factors, or actually is it different? You know, to go back to that point around quality, I know many small to mid cap companies that are well managed and well governed. I know many companies that are heavily investing in the business over the medium term, which means depressed returns. And would I screen those out? That kind of doesn't make sense to me. I guess the reason why it's important is that when someone explains performance in quantitative finance terms, there's a process, right? There's it's called Brinson attribution analysis, where you can look at a portfolio and you can say a portion of the portfolio's returns are coming from factors, from regions, from stock selection. And so you can sort of break this down, and it helps from an allocator perspective to understand the skill set of that investment team, the risk they're running, where the returns are generated. And it becomes a bit more problematic if you're trying to run that analysis as an allocator in an area that where there's very little disagreement about what this actually is.
That makes a lot of sense. And just to clarify for those who are listening who aren't familiar with ESG ratings, it's essentially, for example, MSCI, True Value Labs, Rep Risk. There are a variety of organizations that compare the ESG performance of different companies across regions. And to date, the correlation between the ratings have been quite low. And so there's a question around whether we can achieve standardization, whether there is a unique score, or as you say, whether we're to dig below the scores and look at the source of how those scores are built and then come up with our own scores based on our hypothesis of what matters most.
Yeah, no, I'd agree. And also, I mean, just to frame it out a little bit more, I think there's so much impatience to try and drive towards a common standard or convergence. There are a number of efforts going on. The EU has the European Financial Reporting Advisory Group, which I'm part of. So we're creating a standard and recommending that to the European Commission. The World Economic Forum is working on one, along with the Big Four. So IOSCO is also working on one. So there are efforts, but we've got to think back. When you think of convergence around IFRS, just simple financial accounting, the convergence around IFRS has taken, almost 20 years. So, I mean, we're talking about a very glacial process. Again, we should be patient and more comfortable with the degree of disagreement, because I do expect it will take some time. And one other thing, I think also with these standards, not just with the scores, but the underlying data, I think there's a lot of great work going on, particularly out of the EU. The question though is, in trying to gather, collect, and even sort of legislate or mandate more data produced, one of the sort of tensions is, how do you mandate that across different stakeholder groups, or even within one stakeholder group, companies, corporates? How do you mandate that, recognizing the burden, not just cost burden, but reporting burden that many of these companies are under? Obviously, a large company has an easier time in terms of reporting this than a very small company. How do you sort of take in materiality? How do you account for that across sectors? So, I mean, it's a fascinating area that's undergoing a lot of transformation.
So, Jason, I saw an article that you wrote in the Financial Times last year about greenwashing and what we can expect, what's healthy, what's not so healthy within the industry. And I'm just wondering, I guess it's two questions. How can we tell the difference between ESG on the package and ESG that's true leadership? And any general thoughts on greenwashing that, from your perspective, are important to keep in mind as we embark on this journey?
I think, to go back to that article that I'd written, so I'd written this just prior to the SFDR coming out. And I still think the article holds merit. The article, the title was called, "Is Greenwashing a Necessary Evil?" And the point of it was to sort of question, how orthodox are we? How prescriptive should we be in determining what greenwashing is, or what an ESG product is, particularly in nascent markets? And one of the examples I liked to point out was that, I did a podcast with the Bank of England, and in that they talked about this market, a market that they're trying to help cultivate, called green securitization. And so we've heard of green bonds, but green securitization really hasn't come to the fore yet. But the argument for why it should be developed quickly is pretty compelling. It's effectively trying to take green assets off of bank balance sheets and sort of securitize them and sell them on. But it leaves up really important questions. What exactly, particularly from a bank balance sheet or a loan book perspective, what are green assets? That hasn't really been defined yet. And even the EU taxonomy hasn't really touched on those areas. And so I think out of this question, the point was made that the more orthodox we are in terms of determining what ESG is, does it help or hinder markets? I mean, do we have to live through a period of disagreement to allow certain markets to grow? And then as they start to develop, then do we start to kind of become more rigorous around our expectations? To the credit of the EU SFDR, I actually think that that's what they've done around, when you look at the big focus on equities and fixed income, those are the two most mature markets when it comes to ESG. So it makes sense to sort of tighten the expectations around that. But the fact is, given the urgency around 2030, 2040, or 2050, net zero commitments, I think there's a powerful argument to try and sort of accelerate the amount of available funding there. The question is, how much disagreement is there in terms of what we each determine to be greenwashing or not? From my own perspective, though, and we've done some work trying to understand the products so far in terms of that have come out under SFDR, and it's sort of interesting. I think as the EU launched this, I think that there was a fear by non-EU investors that there would be a race to the top. in a sense, that the SFDR would drive kind of a gold plating, or effectively what was supposed to be protections against greenwashing in an Article 8 context would turn into an ESG badge. So, anti-greenwashing or an ESG badge are a little bit different. And I think there was a fear that there would be this race to the top. I think looking at some product now, I do worry, and I've been public about this, whether now we start to see a race to the bottom. That's a bit controversial, but I think you're seeing some forces start to take shape in that. I think there are some allocators that have, from a wholesale perspective, said our entire platform has to be Article 8. And it's just created a lot of anxiety among many asset managers to sort of force fit, in some cases, products that I would have not thought would have naturally been Article 8 through that Article 8 peg. I think you're also starting to see some products in the quant space within ETFs that are applying sectoral exclusions and adding a little bit of promotional language and effectively calling it a day. And the question is that good enough? And I think lastly, because SFDR, it is a European piece of legislation, but you often find that regional or obviously national regulators are either approving products, particularly like central banks, or regulating them. And I think what you're starting to see is a very fragmented a picture of what ESG is. So if you were to take Belgium and France, they have a much more progressive definition of what an ESG product should be. And that actually seems to, I would say, even subordinate SFDR. And so that manifests in their own labels, their SRI label, as well as the Febelfine towards sustainability. So they seem like very, very good, rigorous, high integrity definitions of what an ESG product is. But you see pockets of this within Europe, but it's by no means uniform.
Two thoughts bubble into my brain as you were answering. One is a generally accepted accounting principles took hundreds of years to develop, and we have a sense of urgency. We need to get to definitions, but in the past, it's taken much longer to come to some sort of agreement and to formalize. And the other piece, just for the listeners who aren't as familiar with SFDR, Article 8, at a very high level, there are three categories in my head for SFDR. You have sort of neutral, so these investments are not considering ESG related principles. Article 8 is, yes, ESG principles are considered, but not necessarily the objective. And Article 9, simplistically, ESG sustainable objectives are the focus. And I think that what we've heard is that there's a lot that can be captured in Article 8.
You pointed out one interesting thing, and I had not known this until recently from an article I'd read, but what's going on right now, sort of this having to kind of explain this process of trying to convey, or if you're an allocator or an auditor, divine, sort of the properties or characteristics of what a fund is. It actually goes back to what an auditor actually used to do. And auditors, from the root word of audible, auditory, right? And an auditor hundreds of years ago would sort of sit across from an account and sort of listen to them tell about the both sides of the accounting. And it kind of feels like this process is sort of playing back, kind of coming full circle in a way, in a informal, messy format before it starts to be more formalized.
And we're on a podcast that is audible, talking
exactly
about the principles. I wanted to gather your thoughts, Jason, on data quality. One of the things that we've seen in the investment sphere is a lack of high quality comparable data has been cited as a barrier to effective ESG investment. And obviously, Man Group is very sophisticated in its approach to ESG. What are some of the challenges that even advanced portfolio managers in this space are grappling with when it comes to data?
Yeah, the best way that I tend to talk about this is, if you can imagine an inverted pyramid cut four ways horizontally, and on that, the larger part of the base, call it unstructured data. And that's, sort of the ether of the internet. It's social media, it's company filings, announcements. And that, from an ESG perspective, there's stuff out there, but it's really difficult to find. Many of it is not relevant. And there are certain tools, whether it's machine learning or natural language processing, that can be pointed at it to divine something. But it's quite difficult. The next layer would be standards. So think about SASB, the Sustainable Accounting Standards Board, or carbon accounting, or natural capital accounting. The next one would be context, and that would be scores. The third-party data providers, and the point of that is a signal or a factor. And so the way I try and explain it is, we as an industry have actually been quite good, I think, in those two middle parts, in terms of collecting and standardizing the data, organizing it effectively in standards. Clearly, as we've talked about, there's going to, there's always more work around this. In terms of contextualizing that, certainly we've gotten better about it. There clearly are some problems, particularly around the fact that there's so much high disagreement, i.e., low correlation among these scores. But it is progressing and developing. I think where we have not done enough as an industry is sort of exploring that unstructured data space. Again, it's quite difficult. The competencies are quite different, and outside of the financial realm, you're talking about data engineers or quant researchers, people with specialized skills to divine something from that. And then how do we use that stack to produce something ultimately that's predictive or revealing or telling about, either the past, the current, or ideally, the future. And I always find that, looking at that inverted triangle, I tell not just managers, allocators, consultants, anyone in the finance industry, you should ask yourself two questions when you look at that. First, where do you enter into this? Do you buy off-the-shelf third-party data, effectively scores, create a product, call it a best in class, that's sort of a strategy that skews towards better scores, and call it a day? That's certainly what many managers are doing. Or do you start to combine that data, maybe even unpick it and combine it with proprietary research and create something that is differentiated and more value add? And I think the industry, we certainly, and many of our competitors are moving in that direction and finding incredibly interesting things out of it. And the second question I like to ask is, what are you solving for? And the answer might seem obvious. I think several years ago, when we really started in earnest around our data effort in this space, it was effectively to, either help with the performance returns of a fund, or even fit within a strategy as a factor, particularly one of our quant multi-factor models. But the reality is, the use cases, there are many others that have sort of emerged, and in fact, just creating a product. And while there's a commercial reality to raising AUM and kind of creating, good product, I think some of the more interesting, intellectually kind of use cases have come out of this, really point to the fact that we're still in the infancy of ESG, that there is a incredible interest and curiosity about where ESG lives, what it looks like, how it acts, how it behaves over a business cycle. Again, this goes back to, earlier, our conversation, this sort of this debate or controversy about whether it even exists and what it actually looks like.
Mm-hmm.
One thing that we're always trying to find, and this I would call almost the holy grail of ESG, is, this idea of isolating or identifying a standalone ESG factor. And again, as I said, most factors out there, if not all that I've seen, aren't standalone factors. If you were to look at MSCI or Sustainalytics and what they're purporting to say is ESG outperformance, is actually outperformance driven by size, quality, and a number of other factors. And that's really problematic because, to give you an example, as an allocator, if we were looking or investing in a strategy that invested in Japan large cap value, those three sort of attributes, we as an allocator would meet with that investment team a number of times in the year, and talk again risk exposure and performance attribution at the start of the meeting, and then inevitably we would talk about company meetings, etc. But those first questions are really important, and they would express those answers in the context of Japan, large cap, and value. If we were to go in there, for instance, and meet with them, and suddenly we saw that a good part of the portfolio was in small cap US growth, there'd be a problem. They would be investing against the mandate which we'd give them money for, and we would likely, almost surely, redeem. So you've got this sort of guardrails, or that sort of framing of these factors, which are incredibly helpful for allocators. The question is, what are those guardrails, or what are those, what's that frame look like in an ESG context? I mean, there clearly has been a lot of progress on the regulatory front. A lot of it has been very process related, though, which is helpful, but it's not ideal. So if we were to go in and meet with a manager who manages, let's say, an ESG fund, and the question is, to what degree is ESG driving your outperformance or your risk exposure? Almost always you wouldn't really get an answer. You'd get the manager sort of flipping to their process page and sort of talking about the investment process. If we as an allocator would ask for more evidence, they would take us to the appendix and show us a few case studies. And the minute they do these, I mean, case studies first are important, but they're a bit duplicitous in a sense, right? Because as an allocator, you're asking a question around attribution. The portfolio manager is giving you an answer not about attribution, but about anecdote, 3 or 4 anecdotes. And those anecdotes don't represent all of the portfolio. They represent, if it were 3 or 4, maybe 15 to 20 or 25% of the portfolio. So a minority of it. More than that, these anecdotes, these case studies have been cherry picked by the manager. And so, are they a true representation of the fund overall, or again, of just this minority of the portfolio? And so the reason I go through this is because from an allocator's perspective, where we want to get to, and this is incredibly difficult, is that as you can start to identify an ESG factor, you can start to understand performance attribution in a truer sense and risk exposure for portfolios. Obviously there are other use applications. You can integrate them within strategies, particularly a quant strategy, but they make really powerful analytics tools for an allocator.
Speaking of ESG being nascent, as we look to the future, in the next 5-10 years, Jason, what are some of the most important trends that will help or hinder the responsible investment movement from your view?
I think legislation has to be one. I think this space is actually full of dualities. I mean, we've touched on some of them, but one of them tends to be how do you sort of push for more progressive, rigorous forms of sustainability? The EU is a great study in terms of making it regulatory or statutory in nature, more prescriptive and rules based, or do you make it looser, more principles based, or more driven by market adoption? And I think in the US, I think partly it was a function of the Trump administration, but you've had an over reliance on market adoption through great standards like SASB. And while they've made significant advancements, I'm on the Investor Advisory Group for SASB. I don't think we've seen enough relative to the huge momentum that the EU SFDR has. So I think legislation is going to play a major, major role in this. Second, I think that call it a democratization of data is going to be a huge benefit. And again, I'm going to have to go back to the EU because I think they, more than anyone else, are sort of thinking along these lines. And because they have that regulatory and statutory clout in the legislation, they can mandate types of reporting. And by doing that, you suddenly get, a comparable of ESG accounting alongside your financial accounting that's accessible by everyone. It might not be the best I think that it has to cater to many different stakeholder groups and many different sizes or types of companies, but it will be democratized, and I think that is incredibly helpful because clearly the costs, and resources involved, but particularly costs around ESG data are becoming prohibitively expensive, particularly for smaller firms. And I think just the third, I would say, and I'm even quite surprised over the last couple of years, particularly since 2019, is the momentum around decarbonization, or specifically the race to net zero. I think there was an assumption that there might be a slowdown through the pandemic, around this, and in fact, I've actually think that we've seen the reverse, an acceleration through it, and through new initiatives like the Net Zero Asset Owners Alliance, the Net Zero Asset Managers Alliance, through clearly a big push by the UK government, and other governments to go net zero, but we're now starting to see better frameworks around that. We, to be clear, at Man Group, are not yet a signatory of the Net Zero Asset Managers Alliance. We're looking at it very, very closely. For us right now, we're just trying to sort of understand the data element specifically. It's easy to make a commitment 30 years out. What we want to make sure that we're able to do is sort of talk about those midterm targets and the shape of the curve as far out as possible using Paris alignment data or other data types.
If we bring it back to, I guess, the actions of the individual portfolio managers, they're looking at these themes that you've just outlined. They want to be a part of ESG trends. They want to be on the front foot, see it as a competitive advantage. If you were a junior portfolio manager and keen to weave responsible investment principles into your approach, what change could you make immediately to make a difference?
So there are a number of resources out there for particularly for young portfolio managers and investors. I think one of the ones that they should look at in particular is the CFA. The CFA now has kind of really developed a whole suite of ESG type educational resources. One of them most recently, which has grown from the UK to a global effort, is the Investing in ESG certificate. In terms of full disclosure, I'm the author of Chapter 8 in that, which is integrating ESG in portfolio construction and management. But in my mind, I said it earlier, there's probably no other organization that sort of can legitimize ESG in the same way that the CFA can, and also sort of couple that non-financial aspect with the great work they've clearly done on the financial side. So I would encourage people to look at those resources and take that test.
One of my favorite questions to ask on this podcast relates to ideas with enduring relevance, because I just think there's a ton of noise in our day-to-day working lives. And one of the things that strikes me about you, Jason, is you have a palpable curiosity and sort of an innovative mindset. I'm just wondering, if you had to choose just one, what is the book or idea that's played an especially significant role in shaping your perspective?
Yeah, I would say, and it's still, I find it interesting that I should sort of cling to this, but when I was doing my master's at LSE a decade ago, I'd stumbled upon a book called The Logic of Sufficiency by Thomas Princeton, and it kind of blew me away. I mean, at the time I was certainly thinking about sustainability, but I wasn't thinking about it in the context of ecological constraints, in terms of how you change behavior, in terms of the life cycle of norms. And so I always kind of go back. I mean, look, to be honest, this book is the MIT Press put it out, so it's not. I don't think it'll ever come out in paperback, but it's one of my favorite books to kind of think about, particularly some of the, I think, the paradoxes, particularly in this space, and how to kind of reconcile them. If I go back, I mean, one of the paradoxes is the efficiency paradox, and you find this within many funds. There's this sort of emphasis around efficiency as a big theme. And over history, i.e. the last 100 to 200 years, you find that efficiency has been this pervasive theme throughout industrialization. But it's a double-edged sword, because there are many cases where, efficiency even 200 years ago in terms of using coal has done nothing else but actually drive up more applications or more usage of that underlying resource. And so, I mean, the book is sort of really, it sort of challenges assumptions and misconceptions, around ideas around self-sufficiency and efficiency and sustainability.
Thank you so much for joining The Future in Sound today. I found this discussion to be fascinating.
Thank you so much for having me on, Jen. I really appreciate it.
Thank you to Jason Mitchell for joining us. You can learn more about his work by checking out the links in the episode description or by visiting re.co.com/The Future in Sound. The Future in Sound podcast is written and hosted by Jen Wilson and produced by Chris Attaway. This podcast is brought to you by Rico, a market intelligence company helping clients achieve resilient competitive advantage in the long term. If you enjoyed this podcast, don't forget to tell a friend about it. And if you have a moment, rate us in your podcast app. Until next time, thanks for listening.